Good evening, and welcome to another episode of the Weekly Market Rep. My name is Daniel Ang, and today, of course, is February the 16th, and we are at the end of the 7th week of 2025. Now, because before I get into the content proper for you lovebirds out there still celebrating Valentine's Day, happy Valentine's Day. Right now, before I get into the content, I have to make a disclaimer. Just be aware that trading of any kind of present of margin products such as FX, CFDs do carry risk. And just be aware that any kind of margin financial products do carry the risk of loss. So make sure that you are aware of your own financial situation before you attempt to trade any kind of margin products. And I'll be sharing you my views on the various markets in the second half of this segment. And just be aware that those are my personal opinions, has got nothing to do with the sponsor IronFX. By the way, IronFX is the sponsor for most of my events on Sunday, and I want to acknowledge them. And of course, the content of this presentation has not been vetted by any regulatory body. Now let's get going. Now, at the beginning of the week, we knew that Donald Trump has imposed a 25% tariff on steel and aluminum. Now, this is coming on the back of his imposition of a 10% additional tariff on China, although earlier on, before he said that he actually imposed a 25% tariff on both Canada and Mexico, which he ultimately put on pause for 30 days. Okay, so we will see what is going to happen. But ever since Monday, when Trump announced this new tariff on steel and aluminum, the biggest loser appears to be Canada, because Canada towers over the other importers, exporters of these two metals into the United States. So we will have to see whether Canada come out with retaliatory tariff, okay? And this is going to be huge, because this actually would have a much bigger impact on manufacturing as far as we are aware. So the fact that Donald Trump is trying to reshore manufacturing, this will actually encourage those marginal players to actually decide, to decide to set up plants in America to set up the smelting of aluminum and the manufacturing of steel. So I think that will be the ultimate game plan as far as Trump's 25% tariff on all imports coming from the rest of the world. Okay, so we will see whether how this will play out. China is the largest producer of both metals, but in terms of exports into the United States, in terms of percentage, I think it is negligible, possibly in the single digit. So it does not impact China as much, but I think it will have a huge impact on Canada. Okay, so going into 2025, I think Canada is going to be hit really hard by the various tariffs that the US is imposing. Okay. And of course, before the release of the CPI numbers, which is on Wednesday, Trump actually reiterate that he wanted lower interest rates. Now, this has been his key theme. He wants tariff, and he wants that to go hand in hand with lower interest rates. Looks like for now, he's not going to get what he wants, because inflation appears to be re-accelerating. Shortly after this comment that he made, interest rates should be lowered, something that will go hand in hand with upcoming tariff. Okay, so that was his second call to lower interest rates. And I think the fact that the Federal Reserve is keeping interest rates unchanged is definitely not going to be in his good book. And I think the one that will bear the bulk of Trump's anger or wrath would appear to be the Fed chairman, Jeremy Powell. Okay, so we'll see what happens. Okay. Then shortly thereafter, Powell made a statement. He said the Fed is not in a hurry to cut interest rates. And this is obviously the case because inflation appears to be re-accelerating. In fact, if you look at the data later on, we will see that headline CPI has actually bottomed out in June of 2024 and has been escalating higher. So in the face of rising interest rates, rising inflation, there is no case for cutting interest rate, because if you cut interest rate just as inflation appears to be accelerating, that will fuel the inflation. Okay, so there is no way the Federal Reserve will be cutting interest rates. However, that sentiment appears to have changed on Friday upon the release of the retail sales. I'll come to that later on. Okay, but for now, Jeremy Powell says that with our policy stand now significantly less restrictive than it has been and the economy remaining strong, we do not need to be in a hurry to adjust our policy stand. So basically, he's going to stand pat on interest rates and observe the data for a few more months before he make any decision. Okay, but for now, any prospect of any interest rate cut has been pushed back way back into 2025. Now, Powell also predicted a time when mortgage rate will implode. Okay, so this is actually bad news. After cutting interest rate from 5.5% to 4.5% from September last year to December last year, we can see that interest rates as far as mortgage rates are not coming down. In fact, it has been climbing, and this is becoming a headache because the housing market is on the verge of actually wobbling. Okay, we can see mortgage rate has been climbing, and this is definitely not a good case going forward. This is on top of the other issues. In fact, personal what I call it, sovereignty rate has been actually been climbing, meaning to say that a lot of US consumers and households are basically not able to service their debt, okay, in terms of credit card debt, in terms of mortgage rates, in terms of car loans. So you can see that the US consumer is definitely suffering. So when Powell made this statement in the middle of the week talking about mortgage rate possibly will be going higher in the coming years. So this is going to be the case going forward, and it will be bumpy going as far as the US economy is concerned, right? Now, there's this other side thing that has been happening because Donald Trump wants to lay off federal workers. In fact, he has succeeded in getting a lot of federal workers, especially those on what call that, as on a temporary basis. Those are the ones they were asked to go. Okay, so as of the last number that we saw, something like 70 to 75,000 federal workers has actually accepted the offer to quit. And when they accept this offer right now, they are promised 8 months of wages. Okay, so whether or not that can be realized remains to be seen. But there are conditions attached. They cannot be seen to be working. So to receive these 8 months of wages. So again, over the next few months, we should see unemployment rates starting to climb, possibly quite aggressively. So this is at the federal level. So we can see that the judge has agreed to allow Trump to continue to offer this quit job, okay, to federal workers. So this is something that is causing the Democrat Party a lot of sleepless night because during Biden administration, that his government had actually staffed a lot of people into federal government's job. Okay, and that has actually skewed the official employment rate. Now, Donald Trump is going to unwind that and asking all these excessive federal workers who do not seem to be doing very much to actually quit. Okay, so he's cutting the size of the government down, and I think that is going to be a short-term pain, which everybody in the States will have to get used to because the government has become too big and too unyielding. So it definitely requires a lot of trimming. Okay, so I think this job has been given to Elon Musk, and I think Elon has been doing a fantastic job in cutting excessive effects from the federal government. Okay. Then the other thing that actually hit the market was there appears to be a very direct communication between the Trump administration and Putin, the Russian government, as to start the ball rolling on negotiation on an end to the war in Ukraine. So this was coming in on Thursday, and the market was very excited because if we have a peace deal, not just a ceasefire, a peace deal that can be negotiated. Apparently, this negotiation is directly between the US government and the Russian government to the exclusion of the EU and NATO. So, and even Ukraine is not involved in this negotiation. So not sure whether this will pan out to be a lasting peace deal, but apparently the fact that the two antagonists are actually communicating directly actually offers the market a bit of a relief, and the market is cheering this. Now, if this actually end up into a peace deal, the one perhaps asset class that will be negatively impact could be precious metals. So, if there is no peace deal, precious metal has been rallying, and that has a lot to do with the very intense and uncertainties surrounding the geopolitics. So if we manage to get a deal done, and fighting actually stopped, that could be actually bringing down the temperature quite a few notches, and that would be bad for gold. Okay, so do watch out if this peace deal actually materialize. Just watch out how the precious metals react. Okay, so for the time being, the market likes what they hear, and this is definitely setting the stage for something quite interesting going forward. Now, the day after news broke that Russia and the U.S. are in direct communication for a peace deal, the Vice President of the United States, this guy called J.D. Vance, actually attended a Munich security conference, and this is what he said. What he speak at this conference was actually quite stunning, because he basically is telling the European that you are on your own, and you are definitely the US is going to wash their hand as far as the war in Ukraine is concerned. He made this remark here, which actually hoarded the headlines here. The threat that I worry most about vice Europe is not Russia, not China. It is not any other external actor. What I worry about is the threat from within, the retreat of Europe from some of the most fundamental values. So this is what he told attendees of the conference, and the European was stunned. Okay, and the reaction came very, very fast. This afternoon, when I read news, the European, in particularly the Germans and the French and the BRICS, are now calling for an emergency meeting, just so that they can come to some kind of respond to the fact that US is basically under Donald Trump is going to wash its hand off Ukraine, and if there's going to be any kind of aids, US is not going to be involved, and that definitely also extend to the rebuilding if a peace deal actually materialize. So I think Russia is also aware of the fact, and apparently the Europeans want to keep the war going, and so this will create a little bit of friction between members of NATO, now that the US is taking a back seat under Donald Trump, and we will have to see whether this will lead to an escalation. And shortly after this conference in Munich, there were report on Saturday that the Chernobyl nuclear reactor, the one that was damaged back in the 1990s, has been hit. Okay, and everybody now is pointing finger at Russia, say that Russia is the one that hit the nuclear reactor. But that nuclear reactor, okay, if it's going to be destroyed, the radiation is going to blow backwards to the four territory that Russia currently has gained from Ukraine. So it's not in Russia's interest to actually attack the nuclear facilities at Chernobyl. Okay, but the news is that Ukraine President Vladimir Zelensky has pointed a finger at Russia, said that they actually attack and actually damage the Chernobyl nuclear reactor. At least the outer protective wall has been breached, and although there was no leakage, but that is a very, very bad development. Okay, so we will have to see what happens. Obviously, the US wants this war to end, and Russia also wants to end that war, but apparently there will be other actors that want to keep this war ongoing. Okay, so we will have to watch. Now, before I go into the economic data itself, let me talk a little. Let me go through the question that you have. Now, if you have any question, just put them into the chat box. I will address them as and when I can. Okay. Why the European prefers the war to be ongoing? Because they invested quite a lot, okay, into Ukraine, and they have been harping about the fact that after Ukraine falls, next in line will be the Western European nations. Okay, so there has been the warmongering among the Europeans. Actually, during the last year, when Biden was the president, he has also been saying the same thing, that if Russia is allowed to win the war is going to extend westward towards Western Europe. And so that has been the reason why the other members of NATO has been behind the Biden administration in trying to provide more support to Ukraine. First, they say is to support democracy. Now it seems to say that Russia cannot be allowed to be seen to have won the war. Okay, so that is a little bit conflicting, right? But appears right now from the language coming out from the French, from the BRICS, from the German, it seems that they want to keep this thing going for as long as possible. But I don't think Europe is in any position to keep the war going. So this latest development about the Chernobyl nuclear facilities is actually quite worrying. Some bad actor is trying to blame the other for actually starting, for trying to attack something that is which is a no-go zone throughout these 3 years of conflict. Okay, so this is not a good development. Somebody is trying to make it a more intense and to actually stop this peace negotiation between the US and Russia. Okay, so we are still too early in this game. Anything can still happen, but it's not something that can be achieved overnight, because the major powers are not in line. Okay, so haven't addressed your question, Roger Kumar. Let me go to the data set that has been released this past week. We start off with China CPI numbers, which is Consumer Price Index. We can see the Consumer Price Index has surged from barely 0.1, now it's at 0.5. So there is a fourfold increase in inflation as far as China is concerned. This is actually seen to be a good news, because we knew from quite some time now China economy has been deflating, meaning to say prices are going backwards. Okay, so now that we have seen a dramatic rise in inflation in China, in terms of the CPI year over year for January at 0.5%, this is seen to be a good development. This is a little bit funny, right? When you talk about inflation, you want it to be a low number. But for China, because prices has been retreating, which is not good from a corporate point of view, because companies, if they cannot raise prices on their goods and services, that means to say they are very aware that consumers' spending is weak, and they cannot afford to pass on the higher prices to consumers. So the only way they survive is to cut prices. So if you cut prices, obviously it will affect the bottom line. It will also affect the ability to reinvest into your business. And of course, from the government perspective, companies that are less profitable will pay less taxes. So it's overall, it's not a good development. Now that inflation is coming back, it shows that companies are able to pass on the higher cost to the consumer, and consumer is actually paying for higher prices. So in that particular light, it seems to be a good development against convention. Okay, so let me see. There are two more questions. No, there's no new questions. Okay, let me go forward. Now, this is the CPI numbers for United States. This is a disaster. This one came in hours after Donald Trump says that he want lower interest rates. With these CPI numbers, that hope of lower interest rates evaporated. Now, when we consider this, there are two sets of numbers here. One is the month-over-month number, which is the chart on the left here. Now, let's talk about this for a while. We can see that since hitting a low in June of 2024, inflation has been climbing. In fact, where it was in January is the highest throughout, including 2024. So this is showing us that inflation in the States is coming back in a big way. Okay, and not only on the headline numbers, we are also seeing the core, which is when you take out energy and food component, which is also rising. Now, from where it was in December was 0.2, now it is 0.4. In percentage terms, that's a doubling of inflation. on just 1 month. Okay, so this is the month over month. The number is not encouraging. It just shows that inflation is coming back in a big way. So the chart on the right refers to the same thing, but it's a year-over-year number. So again, same thing, we have the headline numbers. Inflation is at 3.0% higher than the December number of 2.9%. And on a core basis, when you take out food and energy component, it is at 3.3% in January compared to December of 3.2. So overall, we are beginning to see, we are also seeing the same thing, but the month-over-month numbers are definitely more exaggerated. But here we can see that the headline numbers year over year has been climbing since hitting a bottom in September last year, and it has been climbing steadily. This is the 5th month in which the year-over-year number has been climbing. So it's very much in line with what we are seeing in that month-over-month number, although there's a bit of a lag here, but you can see the trend is suggesting higher inflation is definitely here. Okay, so if this is the case, there is very little the Federal Reserve can do to actually cut rates. They cannot cut rates if they don't want to fuel another massive run-up in inflation. So for now, based on the CPI numbers, there is practically no way the Federal Reserve will be cutting interest rates, much to Trump's dislike. Okay. Now, this is the basically the write-up. It says inflation surge in January, increases in price in durable goods fueled by continued massive month-to-month increase in used vehicle prices and non-housing services such as auto insurance, emissions, and subscription. Now, food and energy also jumped in January. Rent inflation accelerated. That means to say housing is still a problem because on top of the higher mortgage rate, you're also seeing prices of rent has also escalated higher. Okay, so inflation has been accelerating relentlessly since the low point in June of last year. This acceleration pushed the year-over-year increase to 3%, the worst increase since May of 2024. Okay. Now, we also see inflation numbers coming up from Germany. This is the harmonized index of consumer prices year over year for the month of January. You can see it stay constant at 2.8%. Although it did not increase, but it is still elevated at 2.8%. It is matching what we saw back in May last year after dipping to as low as 1.8%. So there is one whole percentage point higher compared to September last year. So inflation is still a problem in Germany. Okay. So GDP, this is the Q4 GDP estimates quarter on quarter. This is referring to the chart on the left here. We can see that there was a surprise picked up in activity. Market was expecting to be a negative number from the Q3 of 0% growth. Market was expecting Q4 to be negative 0.1. It came out 0.1, no doubt, but it's positive. So that is welcome. Okay, but it is still too early to say because 0.1 is basically just one notch higher than 0. Okay, so again, on a quarter-on-quarter basis, UK is not out of the woods just yet. Okay, but when you look at the year-over-year number, that is very encouraging. Throughout the whole 2024, we can see on the year-on-year basis, fourth quarter was the best performance the UK economy has seen. If this number can hold, this will be very encouraging because for the last 4 quarters, it has been climbing steadily from 0.3 to 0.7 to 0.9, and now it is 1.4%. So if you look at this number from this perspective, it does appear that the UK economy is possibly out of the woods. But again, we are looking at a quarter-on-quarter number. It is not encouraging because the trend is still coming down. Okay, so again, we have to continue to watch for a few more quarters to actually be able to confirm. Now, the other inflationary number come at a wholesale level for the United States. We are looking at the US core consumer, the producer price index. This is a year-over-year number. Again, this one is also climbing. Okay, it has been climbing for the last 6 months since July of 2024 from 2.6%. Now it's 3.6%. Again, it is 1 percentage point higher compared to the July number of last year. So again, we can see the wholesale level is at the wholesale level, we can see inflation, imported input cost is still climbing. So again, this will build into higher CPI prices down the road. Okay. Now, when we get to see the GDP numbers for Eurozone as a whole, it basically mirrors what we are seeing in Germany. On a quarter-on-quarter basis, market was expecting no growth. it came in at 0.1% positive, so that's a good sign. In Q3, it was at 0.4, then it shrunk down to 0.1. So this one is an obvious climb down in economic activity. In fact, for the whole year, based on the quarterly basis, 0.1 is about the lowest economic growth for 2024. So about when one look at the year-over-year number, it wasn't that bad. Okay, it remains at 0.9%, although there's no increase, but it still stay elevated. This compare favorably to the beginning of 2024 when it was 0.4%. So we have seen a doubling of this number from 0.4 in Q1 to 0.9% in Q4. So this is seen to be good. But again, we want to look at a quarter on quarter, which is a lot more sensitive. It is not pointing in the right direction. US retail sales actually collapsed. This one was the one major data that was released on Friday, and that caused a bit of a hoo-ha. Retail sales month over month actually collapsed. Okay, in December itself, it was 0.4%. Okay, market was expecting negative 0.1. It was revised to 0.7. Okay, so this is actually almost a doubling of the retail sales number upwards, suggesting that there is some kind of late surge in consumer spending towards the last month of 2024. Now, 2024 is exactly 1 month before the Trump inauguration on January the 20th. So my take is that this late surge with the revision upwards in the retail sales month over month from 0.4 to 0.7 represents a late surge in consumer spending. Perhaps my reasoning is that I think the catalyst could be trying to front run, okay, the expected universal tariff that Trump has been talking about throughout his campaign leading to the November election. So the market already knew when Trump comes in, maybe he's going to go forward and actually do what he promised to do, to impose universal tariff, and that will be seen to be inflationary. So I think consumers are just buying ahead so that, you know, they can try to save some money. Okay, so this is reinforced by the fact that right after December, in January, right after the inauguration, retail sales practically collapsed. Okay, from 0.7% positive, looking at the black color bar, you can see it's negative 0.9. So this is a total 180-degree reversal in retail sales. So if this is going to be the case in the next few months, if we don't see retail sales bouncing back, that could lead to quite a disaster, because retail sales eventually will show up in the GDP. US GDP make up 70% of retail sales number. So if retail sales do not recover back to above the zero line, GDP Q1 could be negatively impacted. Okay, so we want to take this into consideration and look at the numbers here. Even the control group is also negative. From positive 0.7 now is negative 0.8. Okay, so it is actually a more than 1.5% move from top to bottom. So this is not a good thing. There's a new question here. Let me grab this question here. Raja Kumar says PPI numbers, CPI numbers going up and sales number going down. It's indication of stagflation. You got it right. You got it. You hit the nail right on the head. Okay. So when you have elevated inflation and slower growth in terms of retail sales, retail sales is not everything just yet. Okay, but we are seeing a slowdown in demand. If this demand here is structural and not because consumers are front running the tariff that they expect Donald Trump to actually impose, then that will be okay. But if it's going to be structurally permanent for the next few months, then that will lead to lower economic activity. So when you have higher inflation numbers accompanied by lower economic activity, you get the classic stagflation. Okay, high inflation, slower economic growth. That will be a bad position to be in. Okay, so that if that's the case, I think the Federal Reserve would have to consider, okay, saving the economy and not look at inflation. So between the two, one of them would have to be sacrificed. Okay, so if this thing continue and retail sales continue to stay in contraction zone over the next few months, especially in Q1, then perhaps Donald Trump is going to get what he wants, which is lower interest rates. Okay, so this is something that you have to watch. Now, continue. Let me see if there's any other question. There's another question here over Tanvi. Has US and other currencies faced stagflation before? Of course. You look at Japan. Japan has been in stagflation for a very long time, and they only recently managed to get inflation. Earlier on, I did show you the CPI numbers for China, right? So this is what we want to see. If inflation is not climbing, it can only tell us that companies are not able to charge the price they need to charge to remain profitable. And if companies can only rely on lower prices to stay afloat, that is it will create a negative feedback loop, okay, in which when companies are not making money, they can expand their factories, and they can pay higher taxes, and government's inability to collect taxes means they will have to borrow more to finance their various programs. Okay, so overall, it's a bad development if there is no inflation. Inflation too excessive is too bad, but if you have no inflation, or in this case a disinflation, it is not a good development. So you gotta be in a Goldilocks situation in which inflation ideally stays below 3%. Okay, anywhere between 2 to 3% is considered to be the Goldilocks situation, in which companies are still able to charge marginally higher prices and consumers are able to pay. Okay, so that would be the ideal situation. Right. So the story behind this retail sales is that, like I said, in too many words, in not too many words, basically, is that consumers could be front running the imminent tariff that Donald Trump is going to impose on all its trading partners, and that could be inflationary. So if you're a consumer, knowing that things is going to be more expensive come January onwards, you definitely want to go out and buy the thing that you have always wanted to buy just before the increase in prices. So that could actually explain why the December retail sales number has been bumped up from 0.4 to 0.7%. Okay, so this is my take. Okay, it could be different, but I think this is my take here. Okay. Right. In the coming week itself, we're going to see quite a bit of activity. Just remember, Monday is going to be a public holiday in the States. The US market will be closed for President's Day. Okay. So on Monday in Japan, we have the GDP for Q4 quarter on quarter. No change here. The market is expecting 0.3% for Q4. Then on Tuesday, we have the RBA, which is the Reserve Bank of Australia, thinking about interest rate cuts. If they actually cut from 4 and 3.5, okay, the market expect them to be cutting to 4.1. This will be the first cut since interest rates has stayed elevated. So as far as Australia is concerned, this could be their first interest rate cut. They are late in the game. The market has already priced in a lower Aussie dollars. So going into next week, just be aware of this. Then of course, we have labor numbers coming up from UK. We have the claimant count change. They expect to perform they expect more people to be queuing up uh, 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 for for relief, okay, from 700 to 10,000 people. Okay, so this is a big jump in terms of claimant count. Okay, then we have unemployment rate likely to bump up marginally from 4.4% to 4.5%. Then we have Canada reporting their CPI, no estimates here, whether it is the core or whether it is the headline CPI numbers expected to stay at 1.8%. In midweek, we also have the Reserve Bank of New Zealand talking about interest rate cuts. New Zealand is actually one of the very first central bank to actually cut interest rates. They are expected to cut further from 4.25 to 3.75. Okay, so this is already expected, and that could actually see a little bit of weakness in the Kiwi dollars. So, and the CPI for UK, not much of estimates here, except for the core CPI numbers year over year for the month of January, expect to bump up from 3.2% to 3.7%. Then this will be important on the early morning hours of Thursday, which will be at 3 a.m. We're going to see the release of the minutes of the last FOMC meeting. Okay, this will actually move markets. Then early on Thursday morning, we have the labor numbers coming up for Australia. The employment change is going to decrease from 56.3 thousand to 20,000. So there's a big markdown in terms of employability. Unemployment rates expected to bump a marginally higher from 4% to 4.1%. Then on Friday, we have the retail sales for UK. Expect to see a positive number from negative 0.3 to positive 0.3 on a month-over-month basis for the month of January. Then we also have the PMI numbers come from Germany. No estimates previously was 45. Same thing for Eurozone. No estimates. Eurozone will likely mirror what we are going to see in Germany. The last number for manufacturing was 46.6. Services is 51.3. This is followed by the PMI numbers for UK. No estimates here. The services expect to stay about the same at 50.9 for the month of January. US will also be seeing the PMI numbers. Again, no estimates. You got to check this on the calendar the day before. Hopefully by then they will have new estimates. Manufacturing expected to do relatively well at 51.2, back above the expansion zone, and services expected to stay robust at 52.9 based on the January numbers. So this is all we have in terms of what to expect in the coming week itself. Now, if you have no further question, I'm going to go on to the chart to show you the technical outlook. Hang on, I think there's a bit of a last minute question. Hang on. Is there a last minute question? No last minute question. Good. Let me go on to the chart itself. As usual, I will be showing you the Wall Street first in terms of the Dow. Now, the Dow actually have a bit of a challenge of the all-time high. Now, let me just refresh your memory by looking at the weekly time frame. Now, this is the weekly time frame. You can see that this past week has been an inside bar, meaning to say that the price action did not go beyond the trading range of the previous week itself. So, previous week is we have seen at the start of towards the end of January and the beginning of February, we can see that the market actually attempted to take out the all-time high, did not quite did it. Okay, so this past week, the market was very, very tame. There was no spirit in that move, but again, on a close-to-close basis, it remains elevated on the weekly time frame. Okay, just be aware that the market actually reacted quite favorably to the retail sales data, because now that they know the retail sales is weak, there's a possibility the Federal Reserve may actually be cutting rates, unlike what the market was expecting in the middle of week when the CPI and the PPI numbers was released. Okay, so we get a flip in terms of sentiment on Wednesday, Thursday, when the CPI and the PPI numbers was released. The market expect the Federal Reserve to not cut interest rates. By Friday, the weak retail sales now revive back expectation that the Federal Reserve may now have to concentrate more on growth rather than inflation. So that has caused prices, equity prices to actually recover. So this is based on the daily time frame. The market is basically in a very small trading range. Okay, on the upper end near the all-time high at 45,078. Okay, so again, prices are elevated. There's every possibility market may actually take off in the near future beyond the all-time high, okay, because the market underlying tone remains very, very firm. Of course, there is always the possibility market will come down based on certain catalysts that we may not know just yet. Okay, what will cause equity price to come down? If there's a major sell-off in bond market, maybe that will be the case. But for now, technically speaking, the markets, the prices in various equity index remains quite elevated. So if you are going to be holding position, holding a long position is still possibly still viable, but there is no sign that the market is going to topple just yet, at least not in the daily time frame. Okay. Can we see lower prices maybe in the H4, which is the 4 hours time frame? You can see that there is really no momentum. Okay, so anyway, the market could be doing this. Okay, three-wave pullback. If that is the case, there is a possibility the market may be trying to take out this low here. Okay, 43,813. Okay, but that will be assuming a three-wave pullback, just marginally below this low here. Okay, but that will be the best case scenario for people who have not already bought. Maybe this pullback here may present a buying opportunity, but by and large, I think the overall sentiments remains very much positive. Now we look at the S&P 500. S&P 500 has been a little bit more robust in terms of its challenging the all-time high. This week we have a high at 6,125.1, which is just a whisker away from the all-time high, just barely 4 weeks ago. At the start of the year, we have an all-time high in the S&P 500. Okay, we can see this Friday, this week itself, we can see prices now edging higher. In fact, on a close basis, this is about the highest closing price we have seen the S&P 500. So remember, S&P 500 is basically a retail-orientated market here. So if the retail investors are taking this market higher without the Dow Jones following through, that could be a bad news. So any kind of rally in the S&P 500 ideally ought to be followed by the Dow, okay, because Dow represents the international smart money, whereas the S&P 500 represents the retail investors. So if retail investors are taking this thing higher, it's not a good sign, okay? So it must be accompanied by the general markets. And when we talk about general markets, it's usually talking about the Dow Jones, okay? So based on this, we can see the weekly time frame is pressing on taking out the all-time high, which may actually happen pretty soon. You can see that this is the daily time frame. The market here is very positive, okay? So by and large, technically speaking, I think that is the case for higher prices. Just be very careful chasing this market ever higher. And then we look into the 4 hours. Can we see take a look at the 4 hours. 4 hours is definitely pressing on the all-time high. The moment it take out 6,127.2, I think the market again will turn positive. Okay, so again, you have to watch this. Market is technically positive right now. Then we took a Nasdaq, and Nasdaq has a bit of a different structure here. Now, on the weekly basis, it is already new all-time high. Okay, 22,135.1 is an all-time high this week itself. Now, considering the magnificent prices, magnificent 7 stocks that actually carry the Nasdaq is not doing particularly well. Okay, Tesla alone is down 37, I think 27 or 37% so far this year. So the major 7 major tech stocks that has been holding up the Nasdaq is not performing well, but the index is currently at all-time high this past week. So this is definitely chart-wise, it does look very, very positive. And on a daily basis, consider that the price is still trying to go higher. The target, at least for now, is possibly about 23,700. So if the market continues to extend higher, this will be the target. And we look at the 4 hours. 4 hours is also quite elevated. Okay, on a close basis, this is the highest closing so far. So there are times when the market go into this blue area, which is the very deep retracement. Those were the levels in which it's actually favorable to be buying. So if you have not bought the dip here, prices is currently at all-time high. So in conclusion, I do suggest that the US equity market in terms of Wall Street seems to be doing relatively well, technically speaking. Okay. Now let's take a look at across the Atlantic into Europe. Now on the DAX, which is the German index, okay, this past week numbers has been a little bit more supportive. We can see that prices are escalating higher. In fact, the German DAX is at all-time high at 22,625.7. Okay, so this is, you can see every single day it's a positive. Okay, 1, 2, 3, 4, 5, 6 consecutive trading days it has been climbing. So the market is actually buying the dip. Okay, in terms of currencies, we can see that the euro has been before this couple of weeks, the euro has been under a lot of pressure, and that makes European stocks very, very cheap in terms of dollars. Okay, so now the market has been pumped up. Okay, just know that despite a fundamentally weak economy, the equity markets is showing strength. Okay, so again, I'll be watching the European markets for sign of weakness, and I think we may not be able to see weakness in the DAX. Okay, but I think in the Euro stock, I think we are beginning to see a bit of a technical reversal. Okay, later on I'll talk about that. This is the daily time frame. We are all-time high, so the market appears to be having a lot of momentum to the upside. So do not sell this DAX just yet. The one that I think may actually be exhibiting a little bit of a potential reversal is actually the Euro stocks. Okay, the Euro stocks you can see on the weekly time frame is again at all-time high, 5,521.1. So this is an all-time high here. So market appears to be strong, very, very strong. So I take out this one. But when we look at the lower time frame, for example, the daily time frame, where's my daily? The daily is interesting. This is a classical reversal, but this is a single candle. Okay, we need to see much lower prices. But this, the fact that the market break new high and close as a pin bar, technically is a bearish development. So I want to focus on this index here, okay? Because right now the DAX is not exhibiting weakness, but this Euro stocks, which is a mixture of French and German stocks, okay, could be leading the way, okay? So we want to continue to monitor this, because if this end up to be a reversal, the high here at 5,521.1 could be the high for a while. So watch this market here. Then on the lower time frame, can we see confirmation? We don't necessarily see confirmation on the lower time frame. There isn't any. But on the daily time frame, there is that pin bar, which is very, very interesting. Okay. Next, we're going to look at the FTSE 100, which is the UK index. On the weekly time frame, you can see there is also a pin bar. Now, this is a long-legged shadow doji. Market went to all-time high, 8,832.6, followed by a pin bar like this. So now we have two major equity index showing something like this. Now this is even more severe. We don't see this on the weekly time frame in the Euro stocks. We only see that in the daily time frame. But for the UK index to show this on the weekly time frame, this is quite interesting. Okay, so we are beginning to see the lack of momentum going forward to the upside. Okay, so this could be setting the stage for lower prices. For all we know, the market high is already in place. So when we look at the daily time frame, this is actually more encouraging. We can see that there's an outside bar the day where the FTSE 100 break into new high. Okay, this is an outside bar followed by another day of losses. So we have 2 days in which we have negative closing. So like I said, watch this market as well. On the 4 hours, are we able to get some kind of more information? We're beginning to see the start of a counter trend trade. Okay, so I have not taken up any position just yet. I'm waiting for the market to bounce, and if it can bounce, and I will take a look. Okay, but for now, it's very interesting to see the Euro stocks and the FTSE 100 exhibiting technically a possible reversal could be starting soon, okay, or may have already started. Now, let's go into Asia and look at the Nikkei 225. Nikkei remains very robust. We can see that for a market that has not been growing that much, but you can see that it stays elevated. The high traded was actually 4 weeks ago at 40,619. Now the 40,000 has been a magical number. The Nikkei 225 has many times throughout the last few months been trying to break and stay above 40,000. Did not quite succeed. Okay, 3 weeks ago we have another attempt, but prices comes out in the what we call an inside bar, followed by another reversal here. So this is suggesting that on the weekly time frame, momentum is losing. Is easing in the Nikkei 225. Perhaps it's also setting the stage for a pullback. Can we see that in the daily time frame? This is the daily time frame. Okay, I think no conclusive evidence just yet. But if the market do close below this near-term support line here, that could be the first indication that the top is finally in place. So do watch out. The one that is doing relatively well is actually the Hang Seng. The Hang Seng has actually found a second win, okay, largely on the back of the tech stocks. Ever since DeepSeek surprised the market with their LLM, which is the large language model, which is very cost effective. Throughout China, all the tech stocks seems to be getting a lot of win, especially Alibaba, and this has been positive for the Hang Seng for the Hang Seng index. So we can see that this past week itself, there's another massive gain. The week before, we have a run up in prices. This is followed by a second week of running higher. Okay, so I think Hong Kong market and the mainland equity market seems to be getting a win. Okay. In the daily time frame, let's take a look at the daily time frame. It is actually very positive. Now, there is this pivot line that was capping the market for quite some time. Now, finally, the market actually broke above the 21,300 and stays above. And over the last week itself, it remains to stay above this horizontal line here. Now, this line here will act as a support line. If the market ever pull back, this line here should actually likely be able to hold. Okay, so for those who are looking into Hang Seng, if the market ever pull back, this will be a good level to consider, 21,300. So I finished with equity markets. Let's move on to, let's say, the dollar. Now, as usual, I will start off with euro dollar. Now, the dollar seems to be weakening of late. We can see that in the weekly time frame, the euro dollar has actually uh, come back. Okay, so 4 weeks ago, we saw euro dollar actually climbing. This followed by 2 weeks of pullback, and this past week you can see euro dollar is on the march again. Okay, as you can see, I'm holding on to long position, and I'm about to get out if the market hit my first initial entry levels. So it's not so much of a change in fortune. It's just that the prospect of a cut in interest rates as a result of the catastrophic retail sales that we saw on Friday could actually be causing people to be selling the dollar in expectation of lower interest rate by the Federal Reserve. So that is actually buoyant all the other major currencies. So I think the euro is taking advantage of this move here, not so much on the strength of the euro, but it's the weakness or temporary weakness in the dollar. Okay, so I'm still overall bearish on major currencies relative to the dollar. I'm long-term very bullish on the dollar. So this is the weekly time frame. We can see that the major currencies are benefiting from this temporary weakness in the dollar itself. Okay, so this could be the three-wave move I'm talking about. So this is the daily time frame. If the market actually go higher, I think the market could be gunning for 105.65, 67 to as high as 106.50. I'm very happy to be getting out here. This is the line in which I want to get out. Okay, so I'm going to get out just ahead of 105.60. Okay, and I think this is a three-wave move. Unless the market close above 106.30. Okay, then I will take another look. But for now, I'm just happy the price can go back to my original entry price. Okay, so this is the outlook for euro dollar. I think sterling is also about the same thing. You can see the sterling weekly time frame. You can see that sterling has also mimicked that more or less the price movement in the euro dollar. Okay, sterling has actually been climbing higher. So this is part of a counter trend that starts all the way from here. Okay, from 103.63. So this is a long-term rally, okay? But this is a counter trend. So the overall trend is still very much in favor of selling rather than buying. So just be aware that this bounce here is part of a corrective rebound. In the daily time frame, this is the daily, okay? It's still very weak. So if we do get a three-wave rally, what is the prospect of higher prices? I think will be fairly limited, okay? Assuming this is the first leg, followed by second leg, I think somewhere around 126.80. Okay, so it's not far away from the high that we saw this past week at 126.30. So top side initial target is about 126.80. Okay, so very little upside here, and this is happening to be a deep retracement level. So if the price struggles here, okay, then maybe it will cap around this area between 126.60 to 128.10. Right, now we look at the dollar yen. So dollar yen is actually mimicking what we are seeing in the dollar. Generally speaking, the dollar yen has peaked at 158.88 and has been coming down. And this suggests that the yen is getting stronger. And this is also very much in line with expectation that the Bank of Japan is more likely to hike rates rather than cut rates. So that is also favoring the strength in the Japanese yen. So in terms of dollar versus the dollar yen should actually come off. So if this is a three wave, again, using the same thing, okay, if this is a three wave, technically speaking, we could be looking at a move below 140. Where are we now? Okay. If this is a three wave, at 136 half could be where the market may actually end up. So we still have a bit of room to the downside. So we could be possibly looking at near-term weakness in the dollar to continue. So if the dollar versus the yen is any guide, the 136 half is actually a good target to aim for without compromising the very bullish dollar outlook. Okay, so this is the weekly time frame. In the daily, let me see if there's anything worth talking about in the daily. Again, not much has changed. This is a larger degree three wave. Okay, so yes, I think for those who are going to be holding position, you can possibly trade a counter trend. Okay, just know that this in a higher time frame, the dollar remains quite buoyant. Okay, coupled with the fact that the Bank of Japan is more likely to be hiking rates, selling the dollar yen does make a lot of sense. Okay, but again, you have to pick a level. The market did not quite manage to clear the 154.80 this week. So again, this will be the immediate barrier to entry. In the dollar Canadian, we should be seeing weaker dollar, but we have a bit of a jump in prices. So we can see this is a very drastic move in the dollar versus Canadian dollar. Okay, you can see that the market breaks into a high here at just under 148, end up as a very bearish bearish engulfing bar. So this is a very bearish development, okay, which I mentioned last week, right? So this is followed by another week of losses in the dollar. So again, we are beginning to see, technically speaking, the dollar may have hit a pocket and maybe more likely to be trading lower rather than higher. So if you're going into this week, if you have to trade the dollar, I think you'll be safer for those who are doing scalping to trade on the short side of the dollar. I think it's actually quite in line with the higher time frame. Okay. So in terms of the daily time frame, you can see the acceleration is actually extended lower. But overall, you can see the bigger box is green, right? So we want to see lower dollar rates, but once it comes to 134 half onwards, be very careful chasing the dollar on the short side. For now, I think there is still this possibility of a bounce. Any kind of bounce, let's say to 145, would actually be quite ideal to take a look at possible reversal signal to join the market on the short side, at least for now. Dollar Swiss. Let's take a look at dollar Swiss. Now, dollar Swiss has not been my favorite currency pair to trade because it's hardly moved. Okay, we can see market has been consolidating within a very broad band at 83 cents all the way to 92 cents. Okay, so this roughly 9 cents move, okay, is actually where the dollar Swiss has been caught in between. Okay, so in terms of volatility, I would not suggest doing the dollar Swiss trade. Okay, but I think there is a better place to park your money, especially in dollar Canadian or maybe even dollar yen. Okay. In terms of the daily time frame, we have likely see a three-way pullback, but the three-way pullback is possibly going to be ending very, very soon. Okay, so not much of a meat here. Okay, so if you have to choose a currency pair to trade, I would not be favoring the dollar versus the Swiss francs. Now, one interesting part I always keep a constant watch is dollar versus a Sing, okay, which is the Sing dollars. Now, the dollar Sing one is basically telling us that the Sing dollars remains very, very strong, okay. So this week we can see 134 been traded in the dollar versus the Sing. The highest traded was 137. So I'm looking to fund a new account. I'm just waiting for the dollar rate to come down a bit more. Okay, so if the dollar Sing can come down to anywhere about 130, I'll be more than happy to use that rate to actually fund a new account. Okay, so this is a activity I'm watching. I will always look at the dollar Sing, not so much to trade this currency pair, but to actually see, to get a sense of where the Sing dollars is heading. Okay, so this is the daily time frame for dollar Sing. If the market breaks and close below 133 half, I think it confirms that the higher time frame that bear trend is continuing. Okay, but I would need to see prices below 133.60. All right, now I'm done with currency. Let's go into precious metals. Now, interesting thing about precious metal, you can see precious metal has been climbing. This is a record high, $2,942.63. Now, going into 2025, I think Morgan Stanley, okay, actually predict that the price of gold will be at $2,900. It has already exceeded this price, okay, and this is not a good development. Although it is not particularly bearish, but it is still a pin bar nonetheless. And again, this is a weekly time frame. Anything that's happening a reversal pattern in the higher time frame, such as a weekly or monthly, is a lot more significant that it happens on the lower time frame. So when I see this, it suggests that maybe gold could have actually peaked for now, especially with the peace negotiation that may happen very, very soon between the United States and Russia. If there's more positiveness coming up from the talk, there is no reason to buy buying gold. Okay, now there is the other possibility. The price of gold in the spot market, which is what we are seeing here, this is the London price, okay, spot price relative to the COMEX futures price. Now, the two markets are very different, although they are both gold markets. The London market is meant for delivery, and whereas the COMEX New York market is meant for speculation and for hedging. Somebody, I suspect, has been caught on the wrong side of this market here. Now, imagine why there is a shortage of gold in London right now. Okay, if you have not read about the story, I think you should go and read it. Of course, most analysts attribute the shortage in London and higher price in COMEX is due to the tariff. Okay, the narrative is all about the tariff. They say that, okay, if Donald Trump is going to impose tariff on all imports, would that tariff also applies to gold? Okay, so most reports have been saying that is the reason why New York prices are higher right now relative to the spot price in London. But I think it is possibly more than meet the eyes. Okay, I suspect there are some managed fund that has been selling gold now that they, you know, people are demanding delivery. Okay, so there's a long line of people wanting delivery in London. Okay, so that's caused the prices in COMEX to actually jump. Now, between higher prices in COMEX and lower prices in gold, it creates an opportunity. Buy London, sell in COMEX, okay, because also of the premium between the two markets here. So maybe that was the reason why managed fund has been caught on the wrong side of this market here. For an arbitrage position, now the position looks to be tearing. So those, if this is the case, anyone that has been caught selling gold right now would have to buy back at much higher prices. So this could be the reason why we see a squeeze in the gold market here. Because this is my presumption. I could be wrong, but I think it's more than just about tariff. Okay, why does it not affect the other metals? Why only gold and silver? So it seems that what you read in the papers may not be necessarily to be the real reason why we see a gold prices has been escalating higher day after day, week after week. Okay, so this is the story, but based on what we see this past week, this is the pin bar here with the possibility of actually telling us that the market may have hit a temporary high. Okay, so whether that's the case, we will have to watch. Now take a look at the daily time frame. Daily time frame is like that. Okay, no conclusion. Okay, but this is again another two bar reversal pattern. This is a bearish engulfing bar on the 2 days pattern here. So this will actually be setting the stage for lower prices in the coming days. So I do expect a little bit more sell-off to happen in gold markets. Okay, so is this the same thing that we see in the silver market? In the silver, we can see that silver also have not really a classical reversal pattern, but the market went up to as high as $33.38 and closed at $32.13. So that's quite a bit of a climb back. Okay, so we have what appears to be a making of a corrective pattern in the weekly time frame. So if this is the high for this run, okay, using the same equality expectation, we could be seeing a price pullback to as low as $27.40. Okay, so this has the potential to actually pull back without actually damaging their long-term bullish outlook. So if we do see a big pullback in silver to $27.40, I think that would actually create a condition for re-establishing a long position. Okay, so this is the outlook itself. In the daily, we do see a pin bar. This again support the idea of immediate weakness in the silver market. So this is actually of the right color. You can see the wick is pretty long here. Okay, I think it's actually 5 times the length of the body. So this is actually setting up to be a very weak market. So for all we know, like I said, this could be the start of a more meaningful three-wave pullback, targeting the $27.50. Okay, yeah, $27.30 at the minimum. So if this is going to be a three-wave pullback, there's a lot not to uh, to actually be trading on the short side. So near term, I think I am quite convinced this will be ending up to be a top at $33.38 this past week. Let's take a look at oil. Now, oil has not been able to rally. It has attempted many times, but did not quite do it. For the last 4 weeks, this is the 4th week in a row, oil prices has actually climbed back down from the high of $79.35. So again, we are currently in a weekly time frame in this blue area. Now, this blue area is a very deep retracement level. Long term, I am looking to buy, okay, but appears that the buyers are not in any meaningful way just yet. The moment I see a reversal pattern on the weekly time frame for oil, I will be very keen to go long. Okay, for now, there is no sign just yet. Now, the cost of production for American energy producer is about $67. Okay, so I don't think prices can go down a lot from here. In fact, anywhere between $57 to $72 is actually a good catchment area to go long. Okay, so from the cost of production perspective, I think it's getting to be very, very affordable. Anything below $67, it doesn't pay to go into operation, right, to go into production. So I want to see how this thing reacts. All I'm missing right now is a key reversal in the weekly time frame. But I probably will be able to see one in the daily first before I see one in the weekly time frame. Okay, right now there's simply no sign just yet. Price can continue to go lower, anywhere between $68 to $66. This $2 range is going to be quite interesting to watch, because so far we have prices going into this bracket of prices between $66.17 to $68.68. It has always hold. Okay, the most recent low here is $66.51. So allow the price to come a little bit lower into this bracket of prices and start to look for reversal pattern. Like what? Like this. This is a 2-bar setup. Okay, because this is the outside bar, a bullish engulfing bar, or a pin bar. So right now, I'm just looking for any kind of combination or reversal pattern in the lower time frame. Okay, I'm done with energy as well. Let's take a look at Bitcoin. Now, Bitcoin has been pulling back. We can see that the high traded is $109,567 4 weeks ago. That is exactly on Donald Trump's inauguration on January 20th. Since then, the market has been struggling. In fact, it's come off a little bit. Okay, near term, the overall bullish trend is still very much intact. Okay, we have to continue to watch. I think it's lower to buy. For now, I think it's still lower to buy. Okay, at least in the weekly time frame, there's no reversal pattern as yet. So this is the daily time frame. Market could be struggling lower. Okay, if the price can go into this bracket of prices between 81,000 to 85, I think that would be one good area to watch, because this is what we call a value gap. Okay, so if the market ever drift lower, this will be a good price to consider. So once price ever come into this bracket of prices, look for confirmation in terms of price chart. Ideally, we want to see something like this, a pin bar, okay, happening inside this bracket of prices. Currently, it's trading at about 97,000. Okay, it's a bit lower compared to where it was yesterday, but I think the market has no interest whatsoever. So in the other coins, if we look at Ethereum, Ethereum has been underperforming Bitcoin for some time. Okay, so there is really no new high being traded so far. Okay, so the high most recently is at 3,743. And the low traded is 2,136. So allow the price to drift. Okay, right now it's stuck between this 2,100 to 4,000. Okay, so anywhere between these two prices, the market is basically trying to trade the range. it could break out of the range, but it's lower to buy as far as I'm concerned, right? So there's nothing to see here. Let's take a look at Ripple. I think Ripple is exciting. Okay, Ripple has a pin bar the week before, and now it is positive. About the only coin that actually end up the week likely to be positive is this particular coin here called Ripple. Now, there's a lot of attempt to actually launch a Ripple ETF. Okay, the SEC is receiving a lot of application to actually launch a Ripple ETF here. The last company that that was talking about it was actually Grayscale. It's one of the heavyweights. Previously, they have a Ripple Trust. So now they are applying to the SEC to convert the trust into an ETF. Okay, if that get approved, that will be big and that will be positive for Ripple itself. Okay, so I have been looking at Ripple for quite some time. I have not bought any, although previously I did mention anything below $2 was good, but this happened so fast. Okay, I didn't get a chance to go in. Okay, so you can see not only was it fast, it ended up as a reversal pin bar on the daily time frame. So that will set the stage for higher prices as far as concerned. I think $3.40 could be taken out in the next run up. Okay, so based on momentum, I think among the major coins, I think Ripple has a lot of potential. But again, that is just my opinion. Now, there's one more coin I want to show you. This is Solana. Now, Solana has actually got a bit of a publicity ever since Donald Trump launched his own coin. Okay, now it seems that the Trump's family had launched a brand called Liberty Finance. I think something like that. Okay, and they're using the Solana blockchain. Okay, so Solana actually has been in the spotlight of late. So continue to watch this Solana here. It is beginning to get some kind of interest, especially among the meme coin. So let's see what happens. And by the way, the ex-chief of Binance, a guy called CZ, it appears that he's trying to launch a coin very similar to Shiba Inu, okay, which is the dog that the dog coin, so-called the coin that Elon Musk has always been talking about. Okay, so it seems that he may be pumping a new coin. Okay, so go and read about this new coin that is going to be launched by this CZ. Now he's no longer running Binance, but he's still a big wheel. Okay, that means that he has the financial muscle to actually move any new coins if he wants to. Okay, so continue to watch the meme coin, because I think for time being the major coins do not have any catalyst, so the focus will revert to the meme coin. Okay, all right guys, this is all I have for you. Any questions for me? Okay, if there's no question, do remember Monday is a public holiday for the States. I think there are a couple of questions here. Let me see. Anonymous. Okay. Is Nasdaq hitting double top? Based on the closing price, is not necessarily the case. As far as we are seeing, the market is likely has gone to a new high this past week. So there is no question of a double top unless something else happened. Okay. So far, based on what we can see on the weekly, on the daily time frame, there is the momentum is basically behind Nasdaq right now. Okay, so I think all things being equal, I think the odds is that we will probably see higher prices in Nasdaq 100. Jim, would I expect the US bond yield to rise in the long run? Yes, I do, because uh, there is going to be an implosion as far as the sovereign debt is concerned. I think if we do not get a good result coming in from the German election, which is next Sunday, 23rd of February, if Olaf Scholz government is toppled, and if the ultra right wing is able to clobber a coalition party, okay, that will be an earthquake. So that will actually cause the German bonds to actually collapse, and that will have a rippling effect across all the bond market, and that would also mean yield across all bonds is going to rise. Okay, because we are basically facing a worldwide sovereign debt crisis. Okay, so yes, I am actually thinking the yield will have to climb a lot higher, because nobody dares to buy a government bonds because the quality is no good anymore. Okay, Jim is also asking about bonds again. If the US bond yield continue to rise, will it trigger a recession? Yes, it will. Okay. So among professional investors, either you are invested in equity or you're invested in bonds. So nobody dare to touch bond with a 10-foot pole. Okay. So that is quite bad. Okay. And that may actually see more funds flowing into equity markets, but the equity market is not the economy. So the real economy could be facing very heavy headwinds and could actually go into a recession without the stock market actually coming down. So again, we have to watch this peculiarity here. Okay, in most cases, if the economy goes into a recession, typically that will trigger a sell-off in equity markets. But that may not be the case because capital has to be parked somewhere. If it's not in the bond market, they will have to park it somewhere else. Okay, so rising yield will see more people parking into, let's say, treasuries, for example, and just to be in safe haven. Okay, so again, we want to watch. I think bond prices. In terms of bond prices and yield, they are moving in opposite directions. If the yield goes up, the bond prices technically means the E is coming off. And I think we could be seeing some severe turbulence in the bond markets going forward. Okay, I hope I have answered all your questions. Tanvi is asking me, what was the name of the main coin you mentioned? You had to do some research. I can't remember all the coins. Just go and Google Binance CZ or call CZ, okay? And I think his latest news was, I think, just a few days ago, talking about a new dog coin, okay? Very similar to Shiba Inu, okay? Just go and Google it. Anonymous asking, can we look at Kiwi dollars? Okay, I will take a look at Kiwi dollars. I don't trade Kiwi dollars, but let's take a look. Okay, Kiwi dollars is getting a bit of a win. Like I said, the temporary weakness in the dollar has caused all the major currencies to actually bounce. So we are going into a week in which the Reserve Bank of New Zealand is likely to be cutting interest rate again. Okay, so that would mean technically this will not be the best currency pair to go in. Yes, technically it seems to be holding quite well. In fact, it is the highest closing price in the last 8 months, 8 weeks. So that should actually put a floor underneath the Kiwi dollars. But the fact that they are going to be cutting interest rates will be a negative. So for now, both the Reserve Bank of Australia and the Reserve Bank of New Zealand is likely to be cutting interest rates going into this week. Okay, so yeah, the fundamental does not justify higher prices in the currencies. So if you have to do a counter trend in currencies, perhaps the better odds will be in a central bank that is likely to hike interest rates, and that means the Japanese yen. Okay, the other one, of course, you can look at will be Canadian dollars. Technically speaking, it is dollar Canadian is very, very bearish. Okay, so if you have to buy a currency, Kiwi is not where I will be parking my money. Okay, purely because they are cutting interest rates. All right, let me see if there's any other new questions. Okay, no new question. I hope I answered your question, Anonymous. Hope you can agree with me. So in the meantime, if there's nothing else, I will close the session for today. And next week, I will be reporting, doing the presentation from Malaysia. For those in Malaysia who wants to meet up, just give me a buzz. I'll be there for maybe 3-4 weeks before I come back again. All right, guys. In the meantime, you have a great week ahead. Remember, Monday is a public holiday in the States. Okay, so all the best. I'll see you next Sunday.